Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for the next, let's call it 20 minutes here on Options Guide TV. UNH must have been listening to us because United Healthcare has had three strong up candles, and we're now bouncing right up against the 50-day moving average, and it's at a precipice right here. So we're going to start by just looking at, we talked about a couple of the trades on Monday, and I don't want to keep going back to the well. I'll just look at the chart because the chart is interesting. So let's run to the Tradier Pro software right away to start. And this is the longer term chart, but now I'm going to zoom in on United Healthcare. So I'm going to grab the right where this gap is in the chart. So here we go. And so we're right right where this is the huge drop down on them, on the bad news for UNH, and this is the very top of the channel. This is what we wrote up the first time with our butterflies. But look, I did not even draw that trend line. That is actually drawn by the platform, and that's where the stock is at. 342.55. We had this is a golden cross. This is a death cross as far as moving averages are concerned. And I don't put a lot of weight in them, especially when it's a 20-day going over a 50-day. I find it much more interesting when you're dealing with the 50-day and the 200-day. But they're very strong names, Golden Cross, Death Cross. But we finally are seeing the 20-day moving average starting to turn up. And boom, we came right up to that 50-day. And I'm going to scroll out just a little bit here. Came right up to that 50-day. And we've touched 1, 2, not there, but 1, 2. And this is the third time that we are bumping up against it. So something's got to give. Usually after three times of it at least touching the moving average or the resistance area, which is, once again, look at that, right at the top of this candle. Sometimes it just amazes me how markets do stuff like that. And a lot of times technical analysis is wrong. If it was right all the time, this would be easy, right? Everybody in the world would do it and nobody would work. They would just do technical analysis and trade options. So you got to discern where it's at and kind of take your shots. But I really like the fact that we bumped above that 50-day moving average. And if we can close just a little bit higher today, we're up $5, 1.6%, three white candles, things are just, all looking all nice in as far as the chart is concerned. And then the next stop is, looking at the 200-day, and then hopefully go back and fill that gap once again and get all the way back to the 377 and beyond. That would be wonderful. But yeah, good news in UNH. So going into the weekend, I thought hard. We looked at two butterflies on Wednesday around the Fed meeting. We looked at a standard butterfly, which I did in my own account, and we looked at doing an open wing, which was bullish to the upside. And I did say on the show that right after the announcement is when you'd want to look to get out. And I did, and I made a fraction, not enough to write home about on my trade, because I did have the standard butterfly on. And I just, once the announcement came, the VIX dropped about 50 cents. It went from around 17 down to about 16 and a half on that day. But then the markets built momentum going into the end of the day. So if you didn't get out of the butterfly, you got burned. And once again, it's one of those things about, and I don't know if anybody, I got my eye on the chat box down here. I see we got a couple of comments, but, oh, good. Well, I guess we can toss it up here. I still got UNH up. So let's toss up Kurt's comments, and good morning to you, Kurt. So good. I'm glad you're in the diagonal. yeah, I like that trade. I really do. But I have a lot of exposure to UNH. Okay. So, I don't know if anybody did, but I'm just letting you know that I put the trade on in the morning in the AM, got it done for a little bit cheaper, took it off, made about a quarter on it as soon as that earnings announcement came in. Market didn't really move much until it did, and then about a half hour later, it started building momentum to the upside. So the during our show, the open wing butterfly was very expensive. And I thought it would be cheaper, honestly, because one day volatility was up fairly high, and you can see that in the VIX index. So I really thought that the for some reason we just did it too late in the day. If I do the zero DTE butterflies, I have to get on the show and do it. We need to do it at 11 o'clock, and I prefer 10 or 10:30, and I've said that many times. Okay, now let's just look at a trade going into the holidays, and we're going to look at more of a standard trade in Amazon. And I'm going to actually go through the holidays with this trade, and I'm going to set up the trade as I normally would. If I was doing an Amazon trade and it wasn't based off of an event, it wasn't based off of earnings, I guess the event would be the holiday season. Amazon is beaten up a little bit today, and I want to try to take advantage of the fact that it's a little bit of a downturn. There's a little bit of shakiness going on in the Mag 7 stocks, and the Nvidia is just hanging around that good old 180 level at this point in time. Let's see where now we broke below, so we're at 177 in Nvidia, and I think that by the end of the year things will start to grab some momentum to the upside. I don't have a solid, I guess I can't give you one specific reason. Right now the AI trade is going to be volatile. Just the fact that I still think that these companies that are spending all this cash wouldn't be doing it if they didn't see the benefit. And I think that being somebody that's not on the inside, right? I they keep getting beat up for their spend, and you keep having analysts that don't work for the company come in and say, well, there's no way that they can get that spend back. But you know that the figureheads inside those companies are doing that math too. So, all right, enough said. Let's look at Amazon going into the end of the year, and I'm just going to set up, which I don't talk about too much, because Options Guy TV, we're coming up with content Monday, Wednesday, and Friday. And if we do a trade that goes out 45 days or so, by the time 45 days goes away, it's all, the thoughts are already out of your head. But if I'm doing a normal at the money bullish trade in a stock like Amazon, I'm usually going to go out 45 days. Especially I like to do them. You want to know when earnings are, right? Earnings is the one big known event that you can either avoid or you can participate in. Amazon always announces on a Thursday. We like to do butterflies on the Friday afterwards because you got a zero DTE butterfly that you can trade. So in Amazon, I figured today, I'm like, I'm just going to set up what I would do as a standard short spread. And when I'm looking at short spreads, a lot of people like to think of them as, I need to sell these out of the money, and I need to do this as far out of the money as I can, and I need them to expire worthless, and I'm just going to let the trade ride and try to make my dollar on my 5-point wide spread, like at a minimum. I'd rather sell them as an alternative, and my outlook on short spreads is, I'm actually thinking of it as an alternative to the long spread in that I kind of want to try to get the same risk reward. You can't by buying an at the money long spread. So let's say we were just bullish. We're going to go out 45 days. January 23rd is 42 days out. It's almost perfect. It stops right before the earnings. And that rides us all the way through the holiday season. I actually wouldn't mind going the 16th, doing the 35, but we'll go out 42 days because normally my trades would be about 42 days. And we're looking at Amazon. If we bought the long call spread, you do something where you have a decent risk reward, right? If I was going to get bullish and I wanted to have, double the upside, stocks at 226, yeah, it's a little bit in the money. We're paying a lot of premium for that. It's kind of tough. 220 or 225. I'm just doing it as an example. This isn't the official paper trade. And then sell something right about where the one standard deviation move is at. This is a 23 delta. Don't mind that at all. $7 to make 20. So $7 to make 13. I would like to be able to double it up. So if you did the actual math on it, if you'd paid $7, I would like to make 14 on it if I could. But in this instance, just slapping it together, you're buying 225 and you're selling 245. That's 20 points wide. 20 minus 7 is 13, right? That's the maximum that you could approximately make. So it's not ideal, but you're giving yourself much more upside. But your break even is huge. Your break even in this instance is 225 plus 7. So that's 232. And that's my biggest issue with buying something where I'm doing the long spread is I do actually need that stock to make a real decent move by that expiration date just to break even. Now, I'm going to probably get out prior to that, but it's an issue. So let's flip it, okay? So as opposed to doing this, I would actually rather, and I just looked at buying at the money, I wouldn't mind stocks a little bit bigger, selling the at the money. So you sell this one. I don't know why I did two of them. I'm going to sell the 225. And then if we just to make it apples to apples, let's go 20 points wide. And this is the 15 delta, actually. I might not do that, but let's look at it to start. And buy this. So that's 20 points wide, $5.61. And that puts our break even down around 220, just below 220 or 219 and some change. So this would be 20 points wide. We're risking $5 going out 42 days, but our break even is now below, but we can make $5.60. That's the maximum we can make on that trade. On our other trade, right, we were looking at just over $13 on that trade. So if the market doesn't move, if the market drifts higher, I can still, that premium gives me a lot of protection by selling the at the money put and getting bullish by doing a short put spread. I don't have the upside, but it's not too rough here. Now, I would like it to be, I'd probably pull this in a little bit and 225 to 215. So let's pull it in and see what our risk reward comes out at here. So if I'm going to do it on the downside, I'm going to remove this leg, the 205, and let's try it 10 points wide and see what we get on a risk reward basis. All right, so now we're making the width of the spread is 10 points. We're bringing in $3.70. So we're getting more than a third of the width of the spread on this short spread. You're almost, when you think about this, we're a little bit out of the money and we're almost getting as much as as much reward as the risk that we're putting on, right? So the $3.70 is the max credit that we can bring in. $6.30 is the max loss. I like this trade much better than bringing in more money and going the 20 points wide. This is the way I would set it up. Just that simple. If I'm looking to do an Amazon trade, but I like to sell the at the money, bring in the premium, and let that premium protect me. So now my break even is going to be 225 minus that 370. And actually, let's just throw it in the what if calculator. And in this instance, we're going to be breaking even right here. 221.20 based off of approximately where it came in at. It looks like it came in at 370 net credit. But right here, I like this trade as opposed to a long call spread. If I'm just doing normal trades day in and day out, I'd rather sell a near the money put spread than buy the at the money and sell the call spread. I guess that's the moral to my theme today. Now, obviously, if there's something that's bullish, like I wouldn't want to do a short put spread. I'm not saying there's never 100% like answer. There's no golden book of answers when it comes to option trading. But if I were doing this around earnings, I would rather give myself a little bit more upside. So then I'd be much more apt to do a long call spread around that earnings event. But in this instance, or on just a normal trade on a normal stock that you're bullish on, I really like selling the at the money short put spreads. Now, if you are doing something around earnings and you do straddle the market, so let's go back. This is our short put spread. I'm going to make that our official paper trade. Okay. I'm going to take that screenshot for 42 days out, January 23rd, sell the 225, buy the 215. We're going to get bullish on Amazon as we head into the holiday period and try to take, I don't know about advantage. We can actually go look at the chart in Amazon too. Just the fact that there's a little bit of pessimism in the hyperscalers. All right. There's our bounce right off the 200. The 200-day is done well for this underlying. Trading in this middle. Yeah, it's not too exciting in this range. There's nothing to really point out except for that you're dancing between the 20-day and the 50-day. There's a golden cross, but now the market's looking like it wants to do a death cross coming back this direction. Yeah, we're right at that precipice. All right. Well, that's the trade. That's what I'm looking to do this time around on Amazon. But the chart doesn't look that the chart isn't enticing me to say, hey, let's run out and do this trade. But I like where the market is at and just something to get bullish on heading into the Christmas holiday season. Okay. So now let's go back and let's finish this thought. Let's finish this thought on just spreads in general. If you're looking to do a long spread, paying attention to the time premium is a big deal. So let's clear this out and say I did want to speculate, and we'll keep this one 10 points wide. Look at buying about the amount of time premium that I'm selling. And that will usually happen, and we're fairly close to right at the strike, 225. If you go equidistant in the money and equidistant out of the money. And I'm just going to look at the intrinsic value here. Then you're really taking that time factor out of it, and you're just making it a 50-50 trade. I probably wouldn't go out 42 days, but this is not a bad way to go with earnings, where you buy this option contract, the 220 strike, sell the 230, stocks at 225. So without even looking at this, if this is 10 points wide, this should be trading close to $5. It's going to be a little bit more because we're a little bit above the strike, but you see it's $5.30 at the midpoint here. And that's normally going to be the case because you are buying almost as much time premium as you are selling. And whenever that's the case, you're going to have, if you go equidistant in the money and out of the money, time premium is fairly close in the real world. So like, even if we go, let's just do an experiment then. Let's move it 5 strikes. We'll clear this out. Oh, we froze. Okay, good. And let's just buy the 215. And you can see right there, it's $5. And I'm froze a little bit. And then we'd go up and, okay. And then we'd go up 1 strike. So instead of the 220, 230, we'll do the 215, 235. Pay $5 on extrinsic value here. And on the 235, you receive $5.25 of extrinsic value there. So once again, this is going to be about a 50-50 on your risk. So let's buy this one and sell this one. So now we are 20 points wide and we're paying close to $10 and the stock's drifting higher. So it's a little bit more than $10, but it's almost a 50-50 bet, right? If stock was right at 225, it should work out to be very close to a 50-50 bet. There's a little bit of thing going on with the put call parity and the forward value of the stock. But besides that, that's where it's at. So if I'm trading around earnings and I really just want to trade the price and I want to try to take the noise out, and the noise being time value, buy and sell the same amount of time value. And you have to do that by going equidistant in and out of the money, and true risk versus reward. You just flip the coin and see where you're at. Usually like to do those a little bit tighter. But moral to my story today is that we don't talk enough about just standard spreads. And what if you have something that you want to trade, how do you like to approach it? Where you really just want to get long on Amazon or get long on Nvidia because it's gotten beaten up a little bit recently. The way that I like to do it and the way that I prefer to do it is to sell near the money put spreads and make sure that I have almost as much upside as downside. A general rule, or a good way to look at it, is about a third of the width of the spread. If it's 10 points wide, you want to make a 350 or more on it, right? If it's 5 points wide and we're doing that, this type of trade, you're looking at somewhere close to $2. Okay. Any questions on that? We're at time. So UNH, glad to hear that you put the trade on, Kurt. I really like the diagonal spread, and you can roll it too. So the only scary thing that you have going on right now, Kurt, or anybody that is out there, Kurt's the only one that wants to play in my reindeer games. But the only downside that you may have is if the underlying stock gets to 255, not quite there yet, but if we get up to 255, you have to do something with that short call. We have the 26th expiration, the Christmas expiration, but you would have to here's where the range is at right here. But you'd have to either close out the entire trade, which should be at a profit, or you need to roll that call. You just don't want to get assigned on the short-term option. Either close out the whole trade or roll it up and out to the next expiration. And you got a couple of different expirations that you can choose from on there if you'd like, because there's a few more weeks before we get to the earnings report. All right. Thanks for coming, everyone. That's it for this edition of Options Guy TV. We'll be back on Monday, and I'll keep the Amazon trade around, but I mean, I don't know if 45 days from now, if we'll still be looking at it or thinking about it. I'm not personally putting that trade on like I did with the 0 DTE trade, but let's watch it. I just wanted to go through a scenario where let's look at 3 different spreads and decide which one we want to do. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.